Hello everyone, welcome to the Capital Intelligence channel. Today's explainer is diving into something absolutely crucial if you're serious about finance and investing. We're exploring the fundamental tension between the market's demand for total transparency and the corporate necessity of secrecy. If you want to really understand the unseen mechanics of how information flows and how it's legally restricted, you have to understand this dynamic. We're going to give you the most essential information in the world of finance today, delivering the high-value insights you need to see how the playing field is actually structured.
To understand why this information asymmetry is basically baked into global markets, we're going to hit 6 key areas today: the fundamentals of MNPI, regulation fair disclosure, the 8K reporting countdown, the Siebel case loophole, the mosaic theory, and finally, the asymmetric paradigm. Let's get right into it.
All right, Part 1, the fundamentals of MNPI.
So, Material Non-Public Information, or MNPI. Think of this as the ultimate currency of an informational edge. We're talking about everything from pending M&A deals to unannounced executive resignations, or even a heads up that an upcoming earnings release is going to totally miss expectations. If you're operating in capital markets, MNPI is literally radioactive material. Handled wrong, it leads to serious market abuse charges. You absolutely have to know how to track and manage it.
But here's the million-dollar question. What actually makes a piece of information material enough to cross that legal line? It's not just some strict math formula or a simple percentage rule. It all comes down to this legal concept of the reasonable investor. Back in the landmark Supreme Court case Basic Inc. versus Levinson, the courts established that materiality isn't just about hard numbers. It's an objective test. Does this info significantly alter the total mix of information for a reasonable investor? Courts weigh the probability of an event happening against its potential significance, meaning even a seemingly tiny detail is legally material if it completely flips how a rational person views a company's future.
Which brings us to Part 2, Regulation Fair Disclosure.
Adopted back in 2000, Reg FD, or Regulation Fair Disclosure, was the SEC's big attempt to level the playing field. It was specifically designed to bust up that old boys club where executives would just whisper game-changing insights to a few favored analysts or institutional investors behind closed doors. The whole goal was simple: make sure everyday investors aren't left in the dark while financial elites get a massive head start.
In the real world, this rule plays out in 2 distinct ways. If an executive intentionally shares MNPI, boom, they have to disclose it to the public simultaneously, no exceptions. But what if it slips out unintentionally? Like say a CEO just misspeaks at a private lunch. Well, then they are forced into a frantic race against the clock to get that info public promptly, usually within 24 hours. If they knew or were reckless in not knowing that the info was material and non-public, they are on the hook.
And once that clock starts ticking, we enter Part 3, the 8K reporting countdown. You can think of the Form 8K as the market's rapid response system. It gets triggered by major corporate shocks. We're talking sudden bankruptcies, massive acquisition agreements, or even serious cybersecurity breaches. Missing this filing, that's a surefire way to trigger SEC enforcement and totally wreck investor confidence.
Now, here is a high-value insight you really need to keep in mind. Companies have exactly 4 business days to file this disclosure. Just 4 days. That creates this incredibly concentrated window, a literal information lag, where the risk of insider trading is at its absolute peak. Because think about it, the data exists, it's definitely material, but it just hasn't hit the public tape yet.
But, of course, strict rules always crash into messy reality. Let's look at Part 4, the Siebel case loophole. So back in 2005 with SEC versus Siebel Systems, the SEC tried something pretty wild. They tried to penalize a company purely because an executive's optimistic tone and body language in a private meeting heavily contrasted with the gloomy tone of their public statements. They were essentially asking the courts to police implicit communication. It begs the question, can a tone of voice actually be illegal?
Well, the federal court shut that down completely. The judge basically said, look, management shouldn't have to be linguistic experts living in terror of Reg FD just because of their verb tense or enthusiasm. But here's the crazy part. That ruling inadvertently opened up a massive loophole. Empirical research proves that after the SEC lost this case, selective disclosure through private analyst meetings actually skyrocketed. Executives suddenly felt legally covered to communicate through nonverbal cues and tone.
And that legal gray area perfectly sets up Part 5, the mosaic theory.
This is where things get really fascinating. Trading strictly on MNPI is illegal insider trading, no doubt about it. But The SEC totally allows something called the mosaic theory. This is where analysts act like Wall Street detectives. They gather seemingly insignificant, non-material private clues, like noticing how full a factory's parking lot is or tracking an executive's corporate jet, and they legally combine those tiny puzzle pieces with public data to form a highly valuable material picture. The SEC actually encourages this, because analysts doing that legwork provide a huge service to the market.
All right, let's zoom out for a second and look at the macro reality in Part 6, the asymmetric paradigm.
The reality is, MNPI is constantly being generated at every single level of a corporate structure. It's not just the CEO holding the cards. M&A counsel knows about joint ventures early. R&D scientists know a clinical trial failed weeks before the press release hits. Supply chain managers see the lost contracts first. Which means thousands of insiders are constantly holding market-moving data before the rest of the public does. It's an inescapable byproduct of the modern corporate structure.
So here's the crucial takeaway. This secrecy, it isn't a glitch. It's not just a regulatory failure or a sign of corruption. It's an absolute structural mandate for capitalism. Businesses have to operate in private to develop new products and hash out deals. If a company publicized its M&A strategy in real time, competitors would just front-run them and destroy the value entirely. Creating value literally demands a private gestation period.
That's what we call the asymmetric paradigm. As long as information is the primary currency of competitive advantage, these structural lags in public disclosure are always going to exist. It's the ultimate regulatory paradox. We demand transparency from corporations, but we absolutely rely on their secrecy to generate returns.
Which leaves us with a really provocative thought to end today's explainer. If eradicating all insider knowledge means eliminating the very secrecy required to build corporate value, is the pursuit of total market transparency actually fighting against the very engine of capitalism itself? Thank you for joining me on the Capital Intelligence channel today. I hope this deep dive gave you the high-value insights you need to navigate the real mechanics of the financial markets. Keep asking the hard questions and keep learning.